We're checking in on the closing price of oil today, taking a look at where crude is currently trading just to the upside, up at $61.73 a barrel. Now, this coming as the EIA reported that U.S. crude inventory dropped by 5.5 million barrels in the week ending December 20th, a much bigger than expected decline. Well, joining us now is Bob Iaccino. He's co-founder and chief market strategist at Path Trading Partners. And Bob, let's first start with oil. I mean, it's trading above that $60 threshold. Do you expect that to continue?
Hi, Shauna. Yes, I do, actually. Crude oil is set up both technically and fundamentally to take another leg higher when we start the new year, probably reaching at least 64 by the end of the month, end of January, I mean, not end of December. It's not going to happen on Monday and Tuesday. But when you look at it, the technical part is that we broke out of the range that we've been in basically since mid-May. If you take away those two spike highs that we got from the drone attacks in Saudi Arabia, which were quickly reversed, take that out completely, and you've got a range that ended at about $60.60 or so on the upside. We broke it out above that, pulled back to it, and then rallied from that again. So that's a pretty good technical sign. On the fundamental side, there's one weakness, and that weakness has been refinery utilization. Refinery utilization took the longest time to break back up above 90%. When we went into turnaround, it always drops below. Turnaround's the maintenance season, refineries are a little slower. But this was the longest path back to above 90%, which is about where we've existed since 2014 or so, since December of 2011. That was the last time it took this long to get back above there. So I'll be watching that short term. And then long term, drilled but uncompleted wells have fallen. That's a bullish case. 131 well drop in terms of the amount of wells that are ready to be just completed and turned on. You always hear people talk about it when the price goes up. The shales drillers would just turn the spigot on. Well, it's not like a faucet. They have to have these drilled but uncompleted wells ready to be completed in order to do that. And the only place where that increased from October to November is in the Eagle Ford and Haynesville, which is a very small shale field. Permian fell, Marcellus fell. So it's pretty bullish of a case right now.
Bob, we've been talking a lot whether or not it's in demand or if it's a supply story. So demand side of whether or not we're seeing some of the demand fall off because of fears of a global economic slowdown, or also supply. We had OPEC cutting production. When you take a look at it, what do you think is the biggest driver of the price of oil as it stands right now?
Sean, it's a supply story right now, no doubt about it, because the demand is just potential demand. You see demand-led spikes as we get closer and closer to trade deals, which has the potential. The U.S. consumer can't pull the rest of the globe out of the economy, but it can keep the U.S. strong. We have to have some manufacturing and trade growth, and that's just potential growth right now. That hasn't materialized yet. So it's definitely a demand story, again, coming from the idea that shale producers will not be able to ramp up like they have in the past, at least not as quickly, and we've got that OPEC production cut, which Saudi Arabia really threatened its OPEC and OPEC plus partners in the last meeting. Essentially, and this is my opinion, I don't have any inside information on this, just for the record, but my opinion is that they went into that meeting saying, look, you're going to maintain the production cuts, you're not going to cheat. Iran and Iraq, we're looking at you. You're not going to cheat. Otherwise, we'll just sell more shares and go to the debt market to raise the money we need for our budget, and we'll pump like crazy. I think if they did do that, which again, that's just me opining on that, if they did do that, that'll work. So the production cut will actually happen.
Bob, I want to switch gears a little bit and just talk about the broader U.S. markets right now. It's another day that we're hitting record highs. When you take a look at the momentum that we have had over the last several weeks, and really just so far this year in 2019, do you think that there's still reason to buy at this point, or are U.S. equities overpriced?
Well, that's a complicated question. They are slightly overpriced, Shauna, but there is still reason to be long. We've been long, and every position we've taken for the most part has made money. But every time one of those positions makes money, we buy puts down below, whether it be in NASDAQ futures, if it's technology stocks, whether we sell some micro E-minis here at the CME, we take hedges simply because the put skew is very, very high. Not only us, but other institutions and people are coming for puts when they get long. So that means there's some fear, even though the VIX is not elevated, there's still some fear of a downdraft. That's number one. Number two, the last couple of days of rallies have been on very low volume. We don't have the confirmation of that. If you see any sort of a weakness in the employment figures in January, February, that could be a catastrophic crash for the equity markets. However, The bull market being 10 years old, or the longest one on record, when you look at the increase in GDP, it's actually about average. It's not record increase in GDP. So there's room to run if the rest of the globe catches up and if trade deals continue to materialize at a reasonable pace.
All right, Bob Iacchino, thanks for joining me today.